Okay, everyone, Salaam Alaikum and welcome to the Prepare to Pass session for SBR. I'm your trader Hamza Abdul Haq, and we have so far covered 2 days of webinar, day one, day two, and today is going to be the third day. In these 2 days, we mainly focused on the area of consolidation, and we have covered the area of the step acquisition. We have covered the area of the disposal. We have solved one of the foreign subsidiaries question that was of March attempt, and now we are solving the statement of cash flows, which we had discussed yesterday. But there was one question which we were solving, but due to shortage of time, we were not able to cover that. So because cash flow is one of the important topics for the current attempt, and the important topics actually includes two of them: the step acquisition and the statement of cash flows. Even the step acquisition can be asked by you people in case of an income statement or a balance sheet. So either it is going to be an income statement or a balance sheet with the step acquisition, or it is going to be a cash flow one. So I would prefer quickly solving one of the cash flow questions, and I'm going to open the cash flow question. For that, you have to give me just a minute. The question name was Moes. Okay, so I have opened up the question, and no, this is not the cash flow one. We have to move towards the December 2018 exam. So this was the question asked in December 2018 attempt by the name of Moes. Let's move towards the question's requirement, where the question is saying that draft an explanatory note. So we have to make an explanation to the director of Moes, which should include a calculation of cash generated from operations using the indirect method. So we need to prepare the cash flow from operating activities in requirement A1, and then we need to provide an explanation of the specific adjustments that is required um, to the group's profit before tax. So mainly the adjustments that we are preparing in the cash flow from operating activities needs to be discussed as an explanation, and this part is of 12 marks in the paper. So 12 marks are a material exam, are a material marks. So we actually need to score good in this. So let's open the OneNote so that we can solve it over there. And meanwhile, I'm also connecting my mouse so that it's easier to actually operate. So yes, I've got my mouse, and now we are opening the OneNote. Okay, so now we are solving the question by the name of Moes. It's Moyes. And when we talk about the statement of cash flows, we are going to start from the cash flow from operating activities, and we are going to prepare the profit before tax, and we are going to write some of the adjustments where we are going to actually adjust the non-cash and the non-operating activities. After this, after writing down the adjustments, we will be writing down the movement in the working capital, and if we have any interest paid or the tax paid, that will also be deducted from the cash flow from operating activities. This question is of December 2018 attempt, question number 1. Saud is asking the year. It's December 2018. Yes, Arbaz, it is December 2018. Okay, so now if I go back to the question, starting from the top, it says that the following are extracts from the consolidated financial statements of the Moes Group. So the question has given us a group statement of profit and loss for the year ended 30th September 20x8, where we have revenue, cost of sales, gross profit, operating expenses, a share of profit in associate, and the profit before tax. So this is the profit before tax where we are going to start the cash flow from operating activities, and the share of profit is going to be 67, which is a non-cash income, which is added in the profit. So if we go back to the solution that we are solving, we're going to say that the profit before tax is 209, and we are going to deduct the share of profit in associate by 67. So let's make some more space. Okay, so this is how we have started up the question. And in the discussion, we need to mention that why exactly are we deducting the share of profit in associate in the adjustments. The reason is that this is a non-cash income. So because it's a non-cash income, that is why we are removing that from the adjustments from the profit. Now it says extracts from the group statement of financial position, where we have inventory which was 165 in the last year and which is 126 in the current year. So the inventory is actually decreasing. Similarly, the trade receivables are increasing and the trade payables are also increasing. So these impacts are going to be recorded in the movement in the working capital area of the answer. But right now we are not writing it down because maybe we have acquired any subsidiary or maybe we have disposed of any subsidiary. So maybe we need to adjust these values before recording the movement in the working capital. So I'm not incorporating it right now, keeping it aside so that we can incorporate at the end. Moz is saying how many chances that cash flow comes this attempt. Moz, the chances are quite high. Either the cash flow is going to be asked in the September or in the December. So my prediction is it is going to be there either in September or in December. Sardar is saying we can say that 67 is non-operating income. Yes, Sardar, it is non-operating plus non-cash. So any of the reasons will be good enough. Walaikum Assalam, Shahzad Javed. Yavar is saying, is there any chances of debit direct method? Basically, Yavar, the direct method is not a part of the course. In SBR, the only method that is a part of the course is indirect, but the question may ask the direct method theoretically, that what are the advantages of direct method over indirect or advantages of indirect method over direct, but it will not ask us to follow or to perform the calculation using the direct method. Tamina is saying, have you posted anything to the WhatsApp group? Tamina, yesterday I actually updated all of the files over there. So let's continue. The question is then talking about the pension scheme. It says that MOES operates a defined benefit scheme, which means IES 19, and a service cost component of 24 million has been included within the operating expenses. So this 24 million is basically a non-cash expense. So we are going to add it back in the cash flow from operating activities. And instead of this, whatever contribution would have been paid is going to be deducted. So 24 is going to be added a positive value, and whatever the contribution is going to be a negative value. So in case of cash flow statements, IES 19 only has two impacts. One, the service cost component, and two, the contribution paid. Sonia and Deepa are asking that how can we join the WhatsApp group? Sonia and Deepa, admin will share you the link with you people. Apart from that, if you have any problem in connecting, you can share with me on my number. But again, still a lot of people are still yet to be added in the group. And unfortunately, I'm not able to get time, so I will try to to assign this task to someone, adding people in the WhatsApp group. Yes, Sam, the service cost component will always be added because it is an expense and it would have been reduced in the profits. So to reverse that, we are going to add it back. Merrick, the same reason for you too, that this is the service cost which would have been treated as an expense, which would have reduced the profit. So to eliminate its impact, we are going to add it back. Getting the point, Merrick? Sardar is saying how 24 is non-cash. Basically, the entry of the service cost component is expense debit and non-current liability credit by $24 million, which is the defined benefit obligation as a liability. So we are not exactly paying the amount of 24, and the amount that we are supposed to pay is the amount of the contribution, which is credited from the bank and debited to the fund, which is also known as the plan asset. So that is why we say that 24 is a non-cash expense. And if we go back to the question, it says that the remeasurement component for the year was a gain of 3 million, and the remeasurement component is actually something which goes to OCI. So it has no impact on the cash flow statements. Benefits paid out of the scheme were $31 million. Benefits are usually paid from the fund, not by the company. So that is why this is another thing which has no cash impact on the company. This is an outflow from the fund to the employees, but having no impact on the company itself. Contribution into the scheme by MUES was $15 million. So this is the amount of contribution which we should be deducting from the cash flow from operating activities. So in case of IAS 19, there are only two impacts which are shown in the cash flow statement. One is the service cost component and the other is the contribution paid. Okay, so if we read further, the question says that goodwill was reviewed for impairment at the reporting date, which means the year end. Impairment arose of $10 million in the current year. So impairment is again an expense, but a non-cash one. So this would have been reduced in the profit, and to eliminate its impact, we are going to add it back, impairment of goodwill. So we are going to add it back by $10 million. So this is how we are going to reverse the impact of the non-cash and the non-operating income and expenses in the adjustments. Saud is saying normally we use direct method. Saud, normally we use indirect method. Most of the companies prepare cash flow statements using the indirect method. Salman Sarfaraz is saying, so what was the treatment of pension expense on defined benefit plan? Salman, this is the entry that we prepare for the expense on the defined benefit plan. Mohammed Taha is asking, sir, how do we adjust the foreign subsidiary translation gain and loss in cash flow? Mohammed Taha, we do not actually have any impact of the foreign subsidiaries retranslation gain and loss in the cash flow, except for the retranslation gain or loss on its cash and cash equivalents. Apart from that, everything is has no impact. Okay, I'm reading the question further because in today's target we have a lot of tasks to be done. So I will try to take less questions because uh, so that actually we can cover the target that we have prepared. Now the question further says that property, plant and equipment at 30th September 20x8 included a cash addition of 134 million. Now this is a part of CFI, cash flow from investing activities. This has no concern with the cash flow from operating activities. That is why we are going to ignore that. Depreciation charge during the year was $99 million. So this is again non-cash. An impairment loss of $43 million was recognized. So we are going to write depreciation expense of 99, and we also have an impairment loss on property, plant, equipment. So we also need to add it back, which the question says is of 43. But the question also says that prior to the impairment, the group had a balance on revaluation surplus of 50 million, of which 20 million related to property, plant, and equipment impaired. So we have a revaluation surplus of 20 million. So the entry that would have been prepared for the impairment loss would be property, plant, and equipment credit by 43 million. Revaluation reserve or the revaluation surplus debit by 20 million, and the loss of remaining 23 million would have been recorded in the P&L. So this 23 million is the amount that will be added back in the cash flow from operating activities. So this is how we actually adjust the profit to remove the impact of non-cash and the non-operating activities. Now the question further has an adjustment relating to the inventory, which says that goods were purchased for 80 million dinars cash. We have some goods which were purchased for 80 million dinars in cash when the exchange rate was 5 dinars per dollar. Mohammed Idris, we are solving December 2018 question. So we have some inventory purchased for 80 million dinars and the exchange rate is 5 dinars per dollar. Muez had not managed to sell the goods at 30th September 20x8, and the net realizable value was estimated at 60 million dinars. So the cost was 80 and the NRV is 60. This means that there is an impairment loss on inventory. The exchange rate at this date was 6 dinars per dollar. The inventory has been correctly valued at 30th September 20x8 with both exchange differences and impairment correctly included within the cost of sales. So we need to identify what amount of loss would have been recorded in the inventory. So if we go back to the entry section, we are going to say that the inventory's cost was 80 when the rate was 5. So this means the inventory had a cost of $16 million and the NRV is 60 million dinars when the exchange rate is 6. This means that the NRV is now $10 million. So this would have resulted in a loss of how much? $6 million. So the entry would have been P&L debit by $6 million and the inventory credit by $6 million. The entry would be P&L debit by $6 million and inventory credit by $6 million. So now this P&L of 6 million will go to the adjustments in the cash flow from operating activity, and the impact of 6 million will go to the movement in the working capital in the cash flow from operating activities. Both of these values have an impact on the cash flow from operating activities. So if I go back, I'm going to write impairment loss on inventory was of $6 million, which needs to be added back, plus in the question, I'm going to say that the inventory of 165 should be deducted by $6 million. So we are going to write -6 with this. So when we are calculating the movement in the working capital, we will be using 165 minus 6 as the opening as compared to 126 being the closing. So this is how we actually incorporate the impact of the impairment loss in the inventory. Are you all getting this point? Pooja is saying that isn't the loss partly related to exchange rate movement? Yes, Pooja, it is partly relating to the exchange gain or loss. But when we talk about IES 21, inventory is a non-monetary asset, and in case of non-monetary asset, specifically in case of inventory, the exchange gains and losses are recorded along with the impairment loss in the P&L. So according to IAS 21, the gain or loss, exchange gain or loss on all non-monetary assets is recorded along with it. So if it is due to impairment loss, the exchange gain or loss will also go to impairment. Nimra is saying I didn't get the inventory part. Deepa, you can ask this question privately or on the WhatsApp to me, not on the group. You can ask this privately. Badar is saying, so why are you removing it from September 2017? Basically, let me tell you another way. Let's not deduct it from over here. Let's not deduct it from over here. We can simply prepare a T account. If I prepare a T account of inventory, this is what the brought down will be. This is where the carried down will be. And this is where the impairment loss of 6 would be. So if I go back to the question, the opening was 165 and the closing was 125, 126. So this means if we calculate the movement, we are going to say that the opening was 165 and sort of the closing was 132. So the difference would be how much? An increase in inventory of 32. This will give you the same answer. This will give you the same answer as we just did. We said it was 126 and it was 165 minus 6. So if we calculate this, this is going to be 159, which has been decreased to 126. So this is a decrease of 33. This is also 33. And this is also a decrease. Why? Because this was the opening sort of, and this is the closing. So the inventory is reduced from 165 to 132. So this will be a decrease in inventory of 33. Getting the point, everyone? So we have two methods of incorporating this, either make a T account or adjust it in the opening value. Okay, Merrick wants me to repeat that. Merrick, actually, anything that affects the working capital, such as this entry, we are always going to adjust that in the opening value of that working capital. Like for example, if we had a bad debt expense, so the bad debt expense would have been, let's say, by 2 million. So we say bad debt expense debit, receivables credit by 2. So if this would have been the case in the exam, we would have deducted 2 from 149. So in case of any adjustment, we can simply adjust that value in the opening and then calculate the movement in the working capital. So this was just an example. I'm removing that. Otherwise, a lot of people may ask, where did you get 2 from? Yes, Faz is saying the T account approach is more easy. It's actually more logical, but more time consuming too. And in the exam, we need to save time. So when we are building the logic, we actually follow the logical approach, but from paper point of view, we need to have the shortcuts too. Okay, Krantivir is saying that shouldn't the exchange gain or loss go to OCI? Basically, IS 21 was not a part of today's session, but let me give you a brief introduction. Basically, IS 21 has two parts. One is the foreign subsidiary, and one is the foreign transaction. These are two areas which IAS 21 deals with. In case of foreign subsidiary, exchange gains and losses are recorded in the OCI. Thank you, Deepa. And in case of foreign transactions, we have two types. Either the asset or the liability is going to be a monetary asset or liability, or it is going to be a non-monetary asset or liability. For a monetary asset or liability, the exchange gains and losses goes to P&L. And in case of non-monetary asset or liability, the exchange gain or loss has no specific treatment. It has no specific treatment. It may either go to P&L or it may go to OCI depending on the reason of the gain or loss arising. Like, for example, if we talk about an impairment loss, it is taken to P&L. So the exchange gains and losses will also go to P&L. But if we have a revaluation gain, that goes to OCI. So exchange gains and losses along with revaluation gain will also go to OCI. So there is no specific treatment of exchange gains and losses for non-monetary. That depends on the type of the adjustment that we are preparing. And how do we identify monetary and non-monetary? That is again a further discussion. If we start that, we are going to go into IS 21 too much. So this was an overview of exchange gains and losses, that it goes to OCI in case of foreign subsidiary, it goes to P&L in case of monetary assets and liabilities, and it can go either ways in case of non-monetary. So inventory is actually a non-monetary asset and it had an impairment loss which goes to P&L. So the exchange gains and losses would also go to P&L. Fediz is asking that how do we distinguish monetary, non-monetary? Fediz, that will be too much. Anand is saying, do we have to treat monetary, non-monetary in a foreign subsidiary too? The answer is no, Anand. In case of foreign subsidiary, we do not check whether it's monetary or non-monetary. We only check in case of a foreign transaction. So if it's a foreign transaction, we are going to check monetary and non-monetary. Otherwise, it's going to be a otherwise means in case of foreign subsidiary, it will go to OCI in every case. Okay, so let's move back to the question. And we just solved the inventory part, and in the requirement A1 and 2, the only relevant adjustments were actually these till over here. So now we are done with the adjustments. We can write down the movement in the working capital now. And in the movement in the working capital, the inventory was actually decreasing. So we can say that we have a decrease in inventory. We have a decrease in inventory by how much? 33 we calculated. Similarly, if we go and look at the trade receivables, its opening was 149, its closing was 156. This means the receivables are increasing by 7. So it's an increase in receivables. So that will be a cash outflow by 7. And similarly, we have some trade payables which are increasing from 197 to 215. So this is an increase of approximately 218. So increase in payables of 218 means not 218, it's only 18. So increase in payable means a cash inflow. So now we can actually get the total of everything for which we need a calculator. So it is going to be 209 minus 67 plus 24 minus 15 plus 10 plus 99 plus 23 plus 6 plus 33 minus 7 plus 18. So this is going to give us a value of 333. So this is what the answer is to this question. So if we see, these 12 marks were not difficult in terms of calculation, and we actually just need to write the explanation of why we are adding or deducting these values to score the remaining marks out of 12. So I think this was an easy part of the question. And if you have a cash flow statement in your exam, um, that depends of what the examiner is asking, whether it will be easy or not. So let's move on to part B, because this is also an important part. Tasbiha wants the snapshot of IS 21. Tasbiha, here you go. Let me zoom out. This is the entire picture. You can take it. Okay, so now we are reading part B. It says explain. Ali Kiani is saying, sir, can you please make the general T account of interest? Basically, Ali Kiani, the T account of interest is something which is F3 and F7 level T accounts. You will not be supposed to prepare such accounts in the SBR. Salman is saying that, sir, why aren't you answering my question? Salman, I can't see your question anywhere. Okay, let's quickly do part B, and then we are going to move towards the accounting standards today. Rather than solving the framework and the current issues, we'll be solving the accounting standards today and tomorrow. And on Friday, the last day, we will be solving the current issues ethics, so that we have more time on that day. That is why I have rescheduled it to the last day. So let's solve quickly part B. It says explain how the changes to the group structure and dividend would impact upon the consolidated statement of cash flows as at 30th September 20x8 for the Moise Group. You should not attempt to alter your answer to part A. So this actually, the question is asking about the changes to the group structure area. Let's quickly read that, and we're going to answer it in the Word format. So let me have a Word file as well. So we are writing the answer of Moise part B. Now the question says that, okay, it's part B. The question says that during the year ended 30th September 20x8, Moise acquired a 60% subsidiary by the name of Devonport and also sold all of its equity interest in Barham for cash. This means that when we have acquired a subsidiary, we would have paid some cash, which should be treated as a cash flow from investing activities in the cash flow statement. Similarly, the subsidiary that we have sold should be treated as a cash inflow in the cash flow statements. The consideration for Devonport consisted a share for share exchange. In case of Devonport, we have paid a share for share exchange together with some cash payable in 2 years. This means that we haven't paid any cash consideration to acquire the Devonport. So it won't have any impact on the cash flow statement other than the bank balance of Devonport itself. If it's a positive bank balance, we are going to show it as an inflow. And if it's a negative bank balance, we're going to show it as an outflow. 80% of the equity shares of Barham had been acquired several years ago, but Moyes had decided to sell as the performance of Barham had been poor for a number of years. So this means when we have sold the subsidiary, we would have gotten gain or loss on disposal too. So that gain or loss on disposal should be adjusted in the cash flow from operating activities. Consequently, Barham had a substantial overdraft at the disposal date. And what is the treatment of overdraft of the subsidiary? We add it in, in the amount of the cash that we would have received at the time of disposal. So subsidiary's bank balance is deducted and the bank overdraft is added. Barham was unable to pay any dividends during the financial year, but Devonport did pay an interim dividend on 30th September. So when a subsidiary pays a dividend, we actually record the impact that goes to the NCI only. So let's write it down over here. And we are going to say that um, the purchase of Devonport was being settled in non-cash consideration. Therefore, it should not have an impact on the statement of cash flows other than the bank balance of Devonport, which should be shown as inflow, or if it has an overdraft, it should be shown as an outflow. The dividend received from Devonport, the NCI's share in the dividend paid by Devonport should be shown as a cash outflow in the cash flow from financing activities. In case of Barham, the disposal would have resulted in a gain or loss on disposal, which is a non-operating activity, therefore should be adjusted in the cash flow from operating activities. Further, the cash received from the disposal of Barham plus its bank overdraft should be shown as a cash inflow in the cash flow from investing activities. Yes, Jagmeet, you can even say that, but the statement that you are writing is a general one, and it's always preferable to write a specific answer in the exam because we are specifically writing what treatment should MOEs do rather than just writing in a statement. Sam is saying, sir, can we use particular heading for each valid point? Yes, Sam, you can use, but that is a time wasting activity because you are not going to get any additional marks for the headings that you're giving. Merrick is saying that why we treat our overdraft as an inflow. Merrick, we discussed it yesterday that transferring an overdraft is equivalent to having a cash inflow. So you can refer to the recordings of the yesterday. Sabazad is saying is cash flow statement prepared for the year as or as like balance sheet. Saba, basically all of the statements are for the year except for the balance sheet. Only the balance sheet is a statement which is as at. All other statements, P&L, OCIs, statement of change in equity, statement of cash flows, all these are prepared on a for the year basis. Yavar is saying that so no adjustment for dividend received from Devonport to parent exactly. That will be an intra-group trading, so we can say that the portion of dividend, the portion of MOES share in dividend from Devonport would be an intra-group transaction and would have been eliminated while preparing the consolidated financial statements. Therefore, it has no impact on cash flow statement. So we can add this, but this is something which is not very much necessary, but I'm writing it down for your clarity. Okay, so let's get back to the question. So we are done with part A and part B of this requirement. So these were 18 easy marks in the cash flow statements question. So we have discussed the cash flow from operating activities and the impact of purchasing, selling the subsidiary and the dividends. Now let's get back to the part of the presentation. Mohammed Ajmal wants to see the answer once more, maybe to take the snapshot. Let me zoom it out so that it comes on a single screen. You can take the snapshot. Okay, Salman feels that the speed is excellent because today I'm taking less questions. Sorry for that to everyone. But because we are short of time, so I want to invest more time on understanding the standards rather than answering the questions. So I would prefer you people to ask important questions only and to filter out some of the questions from your side. Okay, now let's get back because we have to discuss a lot of major standards today. The first standard that we are going to start with is going to be IFRS 15, which is one of the standards not very much old being introduced in the course. Thank you, Shawan. Now, when we talk about IFRS 15, we actually have a 5-step model for the accounting where each step has different tasks to do. Like the step one is about identifying the contract. This is not control, this is identifying the contract. So step one says that identify how many contracts do we have which are approved by both parties. Similarly, the contract is going to be assumed to be complete if the rights and responsibilities of both the parties are clearly defined. And the payment terms have been identified and there is an economic benefit which is probable from the contract. If any of these criteria is not met, if any one is not met, in that case we cannot record the revenue until the contract is completed and meets all of the following points. However, we will discuss the ethics and analysis and current issues on the last day, day 5 instead of today, because due to consolidation, we have comparatively less time in today's session. So if I start that topics today, we will get less time. So I've planned today's remaining day and tomorrow's day for the standards, and we are going to discuss this dedicatedly on the Friday session. Now let's suppose that we have a question that we have made some sales to a customer who is in financial difficulty. So if the customer is in the financial difficulty, we should not be recognizing the revenue if we are selling it to that customer. So let's suppose that we had a customer who went into financial difficulty in the mid of the year. Customer went into financial difficulty in the mid of the year. So sales before this date will be recorded as revenue. Sales before this date will be recorded as revenue. Plus, if we are expecting the amount is not going to be recovered, then along with this, we are going to record a provision for bad debt. Because after the customer going into financial difficulty, we should be recognizing a provision for the bad debt. Yes, Tamina, you're right. And any sales after this date shall not be recorded as revenue. Until when? Until the cash is received from the customer. Until the cash is received from the customer. So as per step 1, we cannot record the revenue if any of these criteria is not met. Yes, Jagmeet, the credit check will have to be done at the time of signing the contract. But even if after signing the contract, the customer goes into the financial difficulty, even then we cannot record the revenue until we receive the amount from the customer. So this was actually the step 1, and we have a question. So can you people take the snapshot quickly, because I will rub this material to show the question behind. No, Fedis, the entry would be receivable debit revenue credit plus uh, the second entry would be bad debt expense debit and provision credit. So we will have to make 2 entries. Thank you, Salman. Merrick is saying that. So what happens if they receive the goods? Merrick, if they receive the goods, we are going to we are going to reverse the revenue if we have recorded any. Mohammad Ajmal is saying that what do we mean that any one is not met? Mohammad Ajmal, any one criteria out of these 4. Like let's suppose both the parties have approved the contract, the rights and responsibilities are defined, but we haven't identified the payment terms. We have decided that I am going to send you 100 units, but at what price we do not know. So this means that the revenue cannot be recorded until the payment terms have been identified. So if any of the criteria is not met, this means that we should not be recognizing the revenue. Okay. Yes, Yavar, I will share the handouts as well. Actually, the main problem right now is that I am completely occupied throughout the day. Approximately, I'm currently teaching on an average 12 hours per day, and it's very difficult of teaching 12 hours per day and then doing some other tasks as well. So I try my level best to support you people as much as I can. But after Friday, I will have more time comparatively to reply uh, your questions. Yeah, Salman is saying, where are you teaching? Salman, actually, I teach online students as well. Plus, I am teaching at KNS Institute in Karachi, Pakistan, and I'm a full-time trainer over there teaching F7 and SBR. Okay, so let's have a quick question. And This is a question relating to the past papers, which says that Ashanti has sold inventory to both B and C. These companies are actually the subsidiaries of the parent. Okay, but this is an incorrect statement. This is some other case that I've written over here. So we are not supposed to follow that. Sorry for that. No, Salman, I am not based in Lahore, so I'm based in Karachi. Okay, now the next step, step number 2. Step 2 says identifying the performance objective. So after identifying the contract, we need to identify how many promises have we done in the contract. So this means identify the promises made to provide the goods or services. So performance objective means the promise to provide goods or services. And when we say goods or services, we mean distinct goods or services. And what do we mean by distinct? The distinct is goods are distinct if they can be sold separately. So let's suppose that when we have a product A and we have a product B, and both the products are sold together. A cannot be sold without B and B cannot be sold without A. This means that they are not distinct. For the goods to be distinct, it is necessary. It is necessary that both should be able to be sold separately. Okay, Mohammed Saqib, your offer is good. Can think over that. You can drop me an SMS on the WhatsApp. Maybe I can get back to you over there. So goods are distinct if they can be sold separately. But if they can't be sold separately, they will not be distinct. Let's suppose we take an example of an air conditioning system. It has an inner and it has an outer, which is used in um, the process of cooling. So can we sell inner of the air conditioning system separately and outer separately? The answer is no. We can sell them all together, or but it is not possible that someone is buying an inner and not buying the outer, because the inner cannot work on a standalone basis. So in this we say the air conditioning system is a single performance objective. Similarly, if we say that we are purchasing goods and we are getting warranty with it, so now the goods can be purchased separately, but the warranty cannot be purchased separately. So we have two options: either buy the goods without warranty or buy goods plus warranty. We cannot buy the warranty on a standalone basis. So in this case, is this a single performance objective or is this two different performance objectives? What do people think? Is this one objective or two different objectives? Okay, we have different type of answers. Some people are saying one and some people are saying two. Actually, we are going to treat this as two different performance objectives. These are two different performance objectives because there are two possibilities. Either take the goods or take the goods plus warranty. So if there are two possibilities, this means that these are two different performance objectives. And if I take back the example of inner and outer, there's only one possibility: take both or leave both. So this means that when we have take both or leave both approach, that is one objective. And if we can buy any one even, if we can buy any one even, that will become two different performance objectives. Sadar, actually, I will upload them once I get free from the webinar, because right now I am unable to take out the time. But I'm going to cover these topics on Friday, so you can cover that over there. I hope there is no issue in that. Okay. So now coming back, that warranty sold along with the goods for which entity charges an amount separately is treated as a separate performance objective. Now this is also something very important, that we have two types of warranty. One warranty which is completely free, and one is the warranty which is a paid warranty. If the warranty is completely free, this will not be accounted for under IFRS 15. Rather, it is going to be IAS 37. It will not be in the scope of IFRS 15. It will be in the scope of IAS 37. And if the warranty is separately billed, is a paid warranty, that will come under the scope of IFRS 15. Okay, Hiba has a good recommendation. Hiba, I will look into that too. So in case the warranty is provided free of cost, such warranty is recorded under IAS 37 as a provision. And if the warranty is separately billed, separately charged, that will be a separate performance objective. So in the exam, we need to check whether the warranty is a paid warranty or a free warranty. Then we are going to decide the accounting treatment. Yes, Faz, you are also right. Now, if we look onto the step three is identifying the transaction price. In this, we say the transaction price is the consideration that the entity expects to receive. This is the consideration that the entity expects to receive. Zahira, under IFRS 15, it will be a separate performance objective and accounted for accordingly. Now, what do we mean by consideration expected to receive? Let's take an example of sale or return basis. If we take an example of sale or return basis, the company actually sells the goods to the retailers, and the retailers then sell the goods to the end customers. Now, if the company has sold goods of $100 million to different retailers with an option of sale or return basis, which means that if they are unable to sell all of the goods to the customers, they can actually return the remaining goods to the company. Like, let's say we are expecting that the retailers will be able to sell $80 million of the goods, and they will return remaining $20 million of the goods. So in this case, we are going to record the revenue at $80 million. So this is the revenue, this is the consideration that we expect to receive. So in case of sale or return basis, we are going to record the revenue that the entity expects to receive. Further, if there is any amount which is paid to the customer, we are going to treat it as a deduction in the transaction price. Like, let's suppose we have a policy that if the customer consumes $1,000 of the goods or services, we give a cash back of, let's say, $100. So if somebody buys $1,000 of the goods from us, we are going to give a cashback of $100. So this means that for us, the transaction price will be actually $900, not $1,000. For these, the company will record the revenue of $80 million. Onam is saying, so what of the probability changes? Onam, the probability changes will be recorded prospectively. Like we were expecting 80 million to be received, but we got 90 million. So the remaining 10 million will be recorded when we have received that amount. Similarly, if we were assuming to receive 80 million but we receive 75 million, then 5 million of the revenue will be reversed when we actually receive $75 million. So any difference will be recorded prospectively. Any difference will be recorded prospectively. Okay. So any amount which we are paying to the customer will be recorded as a reduction in the transaction price. Okay, so let's discuss the third point, which says variable consideration is only included if it is highly probable. What is a variable consideration? Let's suppose company A is constructing a building for B, for which it is going to receive a revenue of $100 million, and it is going to complete the task in 2 years. But the contract says that A will get a 10% premium if it completes the task before 2 years. So A is constructing a building for B at a price of $100 million and will take 2 years time. But if the building is not completed, but if the building is completed before 2 years, A is going to get a 10% premium. So now we say that the fixed price that A will get in any case is $100 million, and the variable consideration is 10%, which is $10 million. Now, if the question says that there are 80% chances of the construction being done before 2 years, we are going to take 80% of 10 million, which will be 8 million, and the transaction price will become 108 million. 100 million for the fixed price and 8 million for the variable consideration. So if the contract has any variable consideration, we include it at the expected value, but only if it is highly probable then. So this is what the third point was actually telling. Okay, some people wants me to repeat 8 million thing. Basically, let me use the OneNote for that. Basically, A is constructing a building for B at a price of, let's say, $100 million, which is fixed, and we have to complete the task in 2 years time. So the tenure of the project is 2 years, and if we complete it before 2 years, we are going to get a premium, an extra return of 10%. So we are going to say that this is the variable consideration. So 10% is the variable consideration. So we are going to say that the fixed consideration was $100 million and the variable consideration is $10 million. And if there are 80% chance of the consideration of the condition being met, rather than recording entire 10 million, we are going to record 80% of that, which is 8 million. So we are going to say that the transaction price is actually $108 million. Now, if the task is completed, let's say 60% by the end of year one, so we are going to record 60% of the revenue of 108 in year one and 40% revenue of 108 in year two. So this is how we are going to recognize the revenue in case of variable consideration. Basically, Jagmeet, we are expecting it to be 8 million. We do not know that what amount are we going to receive in actual, because we may receive either 100 or we may receive 110. So that actually depends on what is going to be the actual end. Okay, getting the point now? Now let's get back to the presentation. Now, one more thing which is very important is the principal versus agent relationship. What happens is that in terms of IFRS 15, the transaction price actually excludes any amount that we received on behalf of third party. It includes any amount received on behalf of third party. So let's suppose that A is a company who's selling goods to C through B. A is a company selling goods to C through B, and the control is transferred directly from A to C with the help of B. And B gets an amount of $100 million from C. It keeps its 10% commission of 10 million and gives remaining 90 million amount to A. In this case, we say that B is actually an agent who is helping goods to be sold from A to C. So from the perspective of B, B is going to recognize a revenue of only $10 million, which is its own commission. B will record the revenue of only $10 million, which is its own commission, because B is acting as an agent in this case. And what amount of revenue will A record? 90 million or 100 million? Yes, Mary, you are right. So the revenue is for A should be 90 or 100. Okay, everyone is saying 90 so far. Okay, now comes some 100. Actually, the revenue for A is $100 million. Because when we say revenue, this is the amount which we receive from the customer. And the customer for A is whom? B or C? The customer for A is whom? B or C? The customer is C. Yes, exactly. So the amount paid by the customer is 100 million, which should be the revenue for A. So we always recognize the revenue by the amount which the customer is paying. So from A's perspective, it is going to record a revenue of 100 million and cost to sell will be $10 million, and the net impact is going to be 90. So revenue of 100 and a commission expense of 10 million will be recorded in the financials. So yes, 10 million will be a part of cost of sales. So when B is an agent, A will record a revenue of 100, B will record a revenue of 10. But let's say if I change the case and I say that A, B, and C B actually receives the control first and then it transfers the control to C, and it receives 100 million from C and pays 90 million to A. In this case, because B is receiving the control first, we are going to say that the B is actually a principal in this case. Therefore, B should be recognizing a revenue of entire $100 million in this case. So we have to check when recognizing revenue that whether we are a principal or we are an agent. Merrick, specifically not a distributor because the distributor also does not take the risk. The distributor is simply selling the goods on behalf of the company. Okay, what will be the revenue for A in this case? The revenue for A is going to be $90 million because in this case, A's customer is actually B. Because the A's customer is B, that is why A will record a revenue of 90 million. So we record the revenue by the amount which our customer is paying. In the first example, A's customer was C. In second example, A's customer was B. Yes, Jagmeet, B will get a gross profit of $10 million in this case. So we have discussed 3 steps so far. Step 1 was to identify the contract. Step 2 was to identify the performance objective. Step 3 was identifying the transaction price. And now we are moving on to step 4. Step 4 is basically allocating the transaction price to the performance objectives. Allocating the transaction price to the performance objective. The price that we have calculated in step 3 will be allocated to the objectives identified in step 2. Now we say the allocation should be based on relative standalone selling price. What do we mean by that? Let's understand that. Let's suppose we have a product A and a product B. Product A is usually sold for $8,000 and product B is usually sold for $2,000. So we normally sell product A and B separately for a total of 10,000. So we say that A's standalone price is 8,000, B's standalone price is 2,000. Now let's suppose if I am selling these products to you for same $10,000, this means the breakup is simply 8 and 2. If I'm selling these goods to you for $10,000, this means the breakup is simply 8 and 2. But what if I sell these goods to you for $9,000? What will be the breakup in this case? For this, the standard says that where the transaction price includes a variable amount or discount, they can be allocated to one or more performance objectives. So in this case, we have to check why are we giving the discount? Because normally the discounts are given when one product is a running product and the other is not. So if we are giving the discount purely for product A, the breakup will be 7,000 and 2,000. If the discount is purely given for product A, the breakup will be 7,000 and 2,000. And if the discount is specifically given for product B only, the breakup will be 8,000 and 1,000. And if there is no specific product being the reason of giving the discount, rather the objective was a marketing purpose or the purpose was to increase sales, and we have no specific product for which we have given the discount, in that case, we are going to allocate it on a pro rata basis or on a proportionate basis. So we say that on the basis of the standalone price, product A was 80% and product B was 20%. So this means 80% of 9,000 was for product A and 20% of 9,000 was for product B. So in that case, the breakup would be 7,200 and 1800, which will be 9,000. So the breakup actually depends on the reason behind giving the discount. So rather than just allocating on a pro rata basis, we need to check the reason behind first. Now the last step, being step 5, is to recognize the revenue when the performance objectives are met. And the performance objectives are met when the control of the goods have been transferred to the customer. And when is the control transferred? The control is transferred if the legal title has been transferred to the customer, or the physical possession has been transferred to the customer, or we have a present right to the payment. In these three cases, we are going to recognize the revenue. In these three cases, we are going to recognize the revenue as the control has been transferred. Getting the point, everyone? So first we need to check whether the control has been transferred or not. And how is the control transferred? Either we give the legal title, or we transfer the goods physically, or we have a right to the payment. In these three cases, we are going to recognize the revenue immediately. Now the control is actually transferred either at a point in time, or it is transferred over a period of time. If it is transferred at a point in time, we record the revenue when the control is transferred. We recognize the revenue when the control is transferred. Yes, Onam, we can say that. And when the control is transferred over a period of time, we recognize the revenue based on the percentage of completion. We record the revenue based on the percentage of completion. Okay, Salman is saying right to payment means. Salman, basically right to payment means when I have done my part of the task. This means my right to payment has been developed. Like for example, um, if you go, let's suppose to a restaurant and you order some food, and let's say you order a biryani. Now, when the biryani comes, you say that I am no mood of eating the biryani. You can take it back. So this means that the right to the payment of the restaurant has been developed because they have cooked the biryani for you. Even if you are not taking the physical possession of that, or you're not taking the legal title of that because you say I don't need it right now, but the restaurant has done its own work. So the restaurant has the right to get the payment from you. So in any case, if we have performed our task and the customer does not wants that, it's not my fault. My right to the payment has been developed. Okay, Sumaira is saying, but sir, isn't the percentage rule for overtime control finished now? No, Sumaira, I think you have heard it wrong somewhere. The percentage rule is still there because we cannot remove that. Merrick, it's not basically sale or return. Sale or return applies in case of the company selling it to the retailer or the wholesaler, not the end consumer. Okay, Laiba wants to view step 4. Laiba, this is step 4. You can take the snapshot. Salman is saying, what was the accounting treatment for warranty paid? Basically, Salman, paid warranty is a separate performance objective, and we are going to record the revenue for that when when the time period passes during which the warranty can be claimed. So if we are receiving warranty amount of $20,000, the paid warranty we are receiving $20,000 for 2 years. This means revenue of $10,000 should be recorded each year. Okay, so we have some past papers. The question of Carson is quite long. You can try it in the homework. But right now we are solving one of the questions of Kiki. This has a specific case which we need to discuss. The question says that Kiki sells $50 of the gift cards. These can be used when purchasing any Kiki's product through its website. The gift card expires after 12 months. Based on significant past experience, Kiki estimates that its customers will redeem 70% of the value of the gift card and 30% of the value will expire unused. Kiki has no requirement to remit any unused funds to the customers when the gift card expires unused. So this means that we are giving $50 of the cards and people are only using 70% of that, which means $35 are being used and remaining $15 will expire. So at what point of time the revenue of this $15 should be recorded? At what point of time the revenue for these $15 should be recorded? Jagmeet is saying after 12 months. Somebody saying at the start, at the end of 12 months. Okay. Basically, this $15 will be recorded along with the $35 being used. These $15 will be recorded along with the $35 being used. So what we are going to do, let's say if we divide 50 by 35, what value are we going to get? 50 divided by 35? It is going to be 1.4, Yogesh. Yes, 1.4. So 50 divided by 35 is 1.4. So what we are going to do, on use of every $1, we are going to record a revenue of $1.4. On consumption of every $1, we are going to record a revenue of $1.4. So this way, $15 will automatically be recorded along with the 35 one. So rather than recognizing the $15 of the revenue on expiry, we record it along with the amount consumed if we have significant past experience of that. So based on the past experience, we can proportionately allocate the amount to be expired over the period when the amount is being consumed. Getting the point, everyone? Okay. Some people are saying that they didn't get the point of 1.4. Let me get back to this. Basically, what is happening that the people are actually using $35 and remaining $15 are being expired. So what we are doing, we are taking the percentage that what amount should be recorded as revenue. We are recording 50 as revenue on the consumption of 35. So this will give us the percentage, the times according to which we should be recording the revenue. Okay, so let's also write down the answer for that. Yes, Jagmeet, you are getting it right. If I go back onto the answer sheet, we can say that we are talking about the answer of Kiki and its part A1. So we are going to say that as per IFRS 15, the amount of revenue, the amount of non-refundable revenue which expires after a due time should be recorded as revenue when it expires, except for in the case where we have significant past experience to identify the percentage of the revenue which will be consumed. In case of Kiki, it has a past experience that 70% of $50 will be consumed and remaining 30% will be expired. Therefore, the revenue of $15 should be recorded along with the consumption of $35 by recognizing revenue of $1.4 on consumption of every $1. Abhi is asking from where did the 15 come? Abhi, 15 came from 50 million into 30% of the amount which the people are not going to consume. So this is how we have written the answer. And it's 9:30 as well. So we'll be taking a short break. And after the break, we will be continuing. Um, you can take the snapshot quickly so that I can go back to the presentation. So after the break, we'll be continuing with a new question of IFRS 15, and then we'll be moving towards IFRS 16 leases, which is also one of the important standards. In case we don't have the past experience, then we recognize the revenue when it expires. Recorded as revenue when it expires. We have written this in the part of the answer. So you can take the snapshot quickly. Okay, somebody wants to take the snapshot of step 5. This is step 5. So let's take a break of approximately 10 to 15 minutes, and then we are going to continue in a while. So till then, have some rest so that we can invest time onto the remaining part of the today's plan. Okay, everyone, welcome back and let's continue. We were discussing IFRS 15 and we have solved one of the past paper question by the name of Kiki. And now let's solve another question, which is also Kiki, but this is a different part. It's A2. Abdul Qadir wants a snapshot of the question. Here you go, Abdul Qadir. Okay, now we are solving a separate requirement which says Kiki's best selling range of toys is called Scary Mon. In 20x6 color, another listed company entered into a contract with Kiki for the rights to use Scarimon character and imagery in a monthly comic book. Yes, Tamina, we have just started. The contract terms state that Color must pay Kiki a royalty fee for every issue of the comic book, which is sold. Before signing the contract, Kiki determined that Color had a strong credit rating, which means that the economic benefit would be probable. Throughout 20x6, Color provided Kiki with monthly sales figure and paid all amounts due in agreed upon period. At the beginning of 20x7, Color experienced cash flow problems. These were expected to be short term. Color made nominal payments to Kiki in relation to the comic sales for the first half of the year. At the beginning of July 20x7, Color lost access to the credit facilities and several major customers. Color continued to sell Scarimon comics online and through special retailers, but made no further payments to Kiki. So this means that at the time of contract, it was probable that we will be receiving the economic benefit, but later it changed. So we are going to say that if this is 20x6 year and this is 20x7, so till the beginning of 20x6 everything was fine. From here financial difficulty actually started, and in the mid of 20x7 the credit facility was lost. So this means the revenue for 20x6 will be recorded, and we have already received this amount because the question said that paid all amounts due. But in the first 6 months of 20x7, it was in financial difficulty but was short term, which means that still it was probable that we will receive the amount, but later on we couldn't. So this means that this 6 months will be revenue plus a separate bad debt, and in the last 6 months the revenue should not be recorded. So this is what was to be written in this question, that according to IFRS 15, revenue is recorded if the consideration to be received is probable. But if it's not, this means that we cannot record the revenue. And in the question, it was probable during the first year of 20x6, but it wasn't probable during 20x7. Getting the point, everyone? So we have one more question by the name of calendar. You're going to try this in the homework. Johnson says, what about the stock? It is right off to P&L. Basically, Johnson, this is a case where we are actually sharing a toy's name, Scarimon. So this is just the character and imagery which we are giving. So there is no stock for us. Getting the point, Johnson? There is no stock for us. It's just a character that we are sharing. Okay, so do you want me to write down the answer of question for Kiki Abe 2? because I think it's better to discuss the topic of leases rather than writing the answer. What do you people suggest? Should I write down the answer or should I continue to IFRS 16? AOTG is saying yes, right. Leases agree, yes. Next topic. Okay, so it's a mixed feedback. Half of you people are saying to write, half of you people are saying to continue. So let's write it quickly because it won't take a lot of time. So if I go to the answer file and I start writing part 2, we have to say that as per IFRS 15, there is a 5-step model of revenue recognition where step 1 is to identify the contract where the consideration to be received should be probable in order to recognize revenue. So we always start with a general statement and then we are going to write the case specific. This is IFRS 15. In case of Kiki, it was about the a company by the name of Color. So we can say that Color had a strong credit rating. Color had a strong credit rating at the time of contract, which continued till the end of 20x6. Therefore, Kiki should recognize revenue during this period. From the beginning of 20x7, Color faced financial difficulty, but as it was expected to be short term, the revenue shall still be recorded. But after the mid of 20x7, the consideration was no longer probable. Therefore, no further revenue should be recognized, and the receivable amount should also be recorded as a loss, as an impairment loss in P&L. So this is how we have written the quick answer of this question. Okay, so let's get back to the topic of the leases now. I hope there is no confusion till over here. So if we take the presentation further, we are going to discuss the topic of lease arrangements, and we're going to have a discussion on this on the OneNote. So I'm writing IFRS 16 over here. Now, when we talk about leases, what exactly is a lease contract? How do we identify whether the contract is a lease or not? The answer for that is pretty simple, that lease is a contract where the owner, who is also known as the lessor, transfers the right to use of the asset to the lessee, who will use the asset. So basically, lessor, the owner transfers the right to use of the asset to the lessee, the user, against a consideration. This is a case which is called leases. But the right to use should be of a specific asset. It should not be a general asset. Like for example, if A is giving an asset to B on lease, let's suppose it's a car, which A is giving to B on lease, the specific car having a specific license number should be given on the lease, and A should not be allowed to change the car. If A is allowed to change the car, this means the asset is not a specific asset because B hasn't leased a general car. B has leased a specific car with a license of number, let's say 4286. So this license number plate is the car, which is a specific asset given to B to use. So A will not be allowed actually to change the asset, to replace the asset, to substitute the asset. Only then it is going to be a specific asset. Similarly, when we say right to use, it shall be an unconditional right. The right should be an unconditional right to use without any restrictions. So in case lessor transfers an unconditional right to use the asset of a specific asset in return of consideration, we call that case a case of lease. So this is how we identify a lease contract. Yes, Laiba, B will not be allowed, in fact, A will not be allowed to change the asset. It is a specific asset which has been given to lease to B. So I was saying about the license that if A has given a car on lease to B, the car's number plate was 4286. Now A cannot actually replace or substitute the car. Only then we are going to call it a case of lease. If A can substitute the car, then we are not going to call it a case of lease. Getting the point? But let's say if lessor applies a condition on the right to use to the lessee, but it is a condition which is very rare, which does not affect the use of the lessee. In that case, we are going to say that it is equivalent of not having any condition. Like let's suppose A gives a car to B on lease and says that you are not going to take it out of the country, not allowed to take out of the country. Now, if B has no plans to take the asset out of the country, this means that it is a case of lease because there is no restriction affecting B. But if B had a plan of taking the car outside the country, which means it is affecting the use of B, in that case we are going to say that this is not a case of lease. So the unconditional right means any condition that is affecting B should not be there. Any condition affecting the lessee should not be there. Only then we assume it to be a contract of lease. Sridhar is saying, is renting a house an example of lease? Yes, Sridhar, renting a house is an example of lease because the landlord is giving the house to use to someone else. So the owner is someone else and the user is someone else. This means it's a contract of lease. Merrick is saying, but the tenant isn't allowed to change anything. Basically, Merrick, the tenant is allowed to change anything, but it has to restore when leaving the house or the place or the property. So let's suppose if I am taking a property on rent and I want to combine two rooms by breaking a wall in between, I can do that. But when I'm leaving, I need to rebuild that wall. So it's a right to use to me and an unconditional right. but I just need to dismantle that at the time of leaving. Okay, Jagmeet is saying, sir, isn't it just a one restriction, but you have the right to direct the control of the asset? Yes, Jagmeet, but if there's any restriction which actually affects the part of the business of the lessee, then we say that this is not a contract of lease. Yes, Sridhar, we can. So let's continue. The first thing that we are going to discuss now is actually the lessee accounting, that what accounting the lessee is going to do in the financial statements. Let's understand the lessee accounting with an example. That let's suppose we have an asset which has a fair value of $100 million, and the life of the asset is, let's say, 10 years, and we are taking the asset on lease for 4 years, and we are going to pay a lease rentals of, let's say, $15 million, and we have guaranteed a residual value of, let's say, $60 million, and the implicit rate is 10%. So we are going to apply the lease accounting onto this case. Merrick, you have to request this to the ACCA. This is something not in my control. Okay, Abdul Qadir, I will discuss a brief difference between IAS 17 and IFRS 16 and why. Now let's understand the question first. What is an implicit rate? Implicit rate is the rate which is charged by the lessor as an interest. This is the interest rate charged by the lessor for the lease. Similarly, what is a guaranteed residual value? Let's understand this is something important. Let's suppose that let's suppose that A is the lessor and B is the lessee. B goes to A and says that I want an asset on lease which has a life of 10 years, but I want it on lease for 9 years. Now A says that why don't you take it for entire 10 years? B says that no, I want the asset for 9 years only. Now A says that look, if you return back the asset to me after 9 years, it has no use because I cannot lease it to someone else. Nobody would buy such asset from me. It's of no use to me. So the last year will be a total loss. Why should I give you the asset on lease for 9 years? B says, okay, I guarantee that this asset would be sold in the market for, let's say, $10 million. And if nobody buys it in the market for at least $10 million, I'm going to buy it for $10 million. So B has given a guarantee of the residual value that if nobody buys this asset from you, you can sell it to me for $10 million. This is called the guaranteed residual value, an amount of residual value guaranteed by the lessee, sorry. So A says, okay, fine, you have got the asset, take it. Now A calls someone of his own. A calls someone of his own and asks that what will be the residual value of this asset after 9 years. A's person says that, sir, it will be around $15 million. So this means out of $15 million, A has got a guarantee of $10 million, and remaining $5 million is called the unguaranteed residual value. So guaranteed residual value is the amount by which B has given a guarantee to the lessor that if nobody buys it, I will buy it from you. This is not an option to buy. This is not an option to buy. This is an option with the lessor to decide whether to give the asset to the lessee and take 10 million or sell it in the market. So now what accounting do we do in this case? We are going to record an entry in year 0 as the right to use asset debit and the lease liability credit. By what amount will we record this? We are going to record this by present value of all future lease payments. So what are the lease payments? If we calculate the present value, we're going to say that we are going to pay rentals for the next 4 years, year 1 to 4, where we are going to pay the rentals of 15 million. And in year 4, we are going to pay a guaranteed residual value of 60 million. These are the lease payments that the lessee is going to pay. And the discount factor is 10%. So we need to calculate the present value of this. So to calculate the present value of this, the annuity factor for year 1 to 4 is going to be 3.17, and the discount factor for year 4 at 10% is going to be 0.683. So if I calculate these values, the present value is going to be 47.55 for year 1 to 4, and 60 into 0.683 is going to be 40.98 for year 4, and if we calculate the sum, it is going to be 88.53. So this is the value, being the present value of all future lease payments. We are going to record the right to use asset and the lease liability by 88.53 in year 0. Merrick is asking, how did I get 3.17? Merrick, this is the discount factor. I actually remember the discount factor, but you can actually calculate the annuity factor as the formula of 1 minus 1 plus I to the power minus n divided by I. Getting the point, Merrick? Yes, Onam, if any amount is paid immediately, we do not need to discount that. Ripon is saying, why 15, why not 10? Ripon, the answer is pretty simple, because we have promised to pay the rentals of 15 million. And we have promised to pay an amount of 60 million every year. Ripon, the lessee will pay 15 million every year. Because your question is actually, why would somebody pay $15 million? The reason is that these rentals actually includes two things. This includes the interest and this includes the principal amount. Abhaya is asking, sir, is that the table given in the question? Basically, Abhaya, there won't be any table given in the SBR exam. You need to calculate that on your own. Johnson, yes, you will need to differentiate between the non-current and the current liability portion, but this is something not relevant for SBR. The examiner wants some more technical points from us. Jawad Ahmed is saying, sir, shouldn't we include 60 if it is probable? Jawad, basically, anything which the lessor is going to decide, uh, uh, we are going to record that as a liability, because we assume the worst case when we are talking about an obligation or a liability. Nabia is saying, will we unwind this every year, right? Yes, Nabia, we are going to unwind that. Now what we are going to do after year 0, in year 1 to year 4, we are going to prepare a lease table as the year, interest, rentals, principal repayment, and the carried down. Abesta is saying is that a finance and an operational lease. Basically, Abesta, the operating and finance lease for lessee was there in IAS 17, but not in IFRS 16 now. So the finance lease has changed to lease accounting and the operating lease has changed to lease exceptions. So in year 0, the lease liability was 88.53. In year 1, we're going to recognize the interest expense at 10%, which is going to be 8.85. And the rentals that we were paying was supposed to be 15. So 15 minus 8.85 is going to be 6.15 of the repayment, and the carried down will become 82.38 at the end of year 1. Yes, Abdul Qadir, we are assuming the rentals to be in arrears right now. The interest for second year is going to be 8.24. Again, we are paying 15, and the repayment is going to be 6.76. If I'm not wrong, 15 minus 8.24, it's 6.76. And 82.38 minus 6.76 will be 75.62 of the liability at the end of the second year. Similarly, in year 3, the interest is going to be 7.56. We are paying 15. So it is going to be 15 minus 7.56. The repayment this time is 7.44, and 75.62 minus 7.44 will be 68.18. And in the last year, the interest is going to be 6.82. Out of 15, if we deduct 15 minus 6.82, it is going to be a repayment of 8.18, and the liability will at the end will automatically become the guaranteed residual value because we haven't paid that yet. Okay, Laiba is saying that I'm going a bit fast, and you guys say that you have elephant memory. Oh my god. So Nabia is saying, sir, I don't understand what the repayment represents. Nabia, basically, the asset that we have taken is of 88.53, which we have to pay an amount for the asset. Apart from interest, we have to pay an amount of 88.53 for the asset. So the principal amount basically represents the asset. Let me let me make you understand like this, that for example, I want a car on lease. I want a car on lease and you are the bank. Now you are going to purchase the car for me. So you are going to charge me the amount of the car plus the interest. You're going to charge both from me because you are purchasing the car for me. So you are going to charge the value of the car plus the interest. So the value of the car that you are charging from me is called the principal amount. Getting the point, Abhiyam? So the value of the asset that the lessor is charging is the principal amount, and the value of the interest that the lessor is charging is the finance cost, interest cost. Merrick is saying repayment is the principal amount. Yes, exactly, Merrick. Repayment is the principal amount that we are repaying. So it's a principal repayment. Its full form is principal repayment. Yes, Ahmed, you can even write the broad down as well. Avesta is saying that why did you deduct the interest first and not the installment? Avesta, basically The rentals has both the elements interest and the repayment. So we have divided 15 in the 8.85 and the 6.15. If the rentals would have been in advance, then what you are saying would have been right. Exactly, Merrick, you are getting it right now. Okay, so now if we record the entries in the first 4 years, we are going to say that the finance cost should be debited by 8.85 plus the amount that we are paying from the bank is of $15 million. So we are paying an amount of $15 million, out of which the finance cost is 8.35. So the amount of lease liability is going to be 6.15. So this is the entry of the finance cost that we'll be recording in year one. No, Marek, exactly not. The statement that you are saying is isn't right, that the repayment is equivalent to depreciation. It should ideally be, but it will never be actually. Abhiya, the split of current and non-current is something which is not quite important, but actually the at the end of year one we say that 75.62 is going to be the non-current liability for year one, and 6.76 will be the current liability at the end of year one. But this is something not very much important from SBR's perspective. Now, apart from that, we also need to depreciate the asset every year. Can someone tell me the amount of the depreciation that should be charged? Can you tell me the amount of the depreciation that should be charged every year? Okay, a lot of answers so far, but I think none of them are right. Basically, when we are calculating the depreciation, 88.53 was the value of the asset minus 60 being the guaranteed residual value. We are going to deduct the residual value of 60 million first, and then we are going to divide it by 4 years. So it is going to be 88.53 minus 60 divided by 4 years. It is going to be 7.13. So only one answer of Rida Awan was correct. So it's $7.1 million being the depreciation every year. Jagmeet is asking that why have we deducted 60 million? Jagmeet, let me continue the answer, then I'm going to answer your question. So now we are charging depreciation of $7.1 million every year for how many years? For 4 years. So what will happen? What will happen after 4 years? The cost of 88.53 minus the depreciation of 7.13, after 4 years the depreciation is going to be how much? 28.53, and the asset will this way be brought back to 60, which was the guaranteed residual value. So when we deducted 60 million from the depreciation, this has resulted in the asset's net book value of 60 million after 4 years. Yes, Merrick, we have to account for the depreciation separately as well. Now, what will happen? Do listen this very carefully. At the end of year four, at the end of year four, now there are two possibilities. Either the lessor will ask us to pay the guaranteed residual value, either the lessor will ask us to pay the guaranteed residual value, or it will ask us to return the asset. There are two possibilities. Either we are going to return the asset to the lessor, or we are going to pay the residual value. So let's suppose if the lessor asks us to return the asset, we are going to make an entry as the lease liability debit by 60 million and the right to use asset credit by 60 million, because both the values are at the same amount at the end of year 4. So my liability was 60 million at the end of year 4. My asset is at 60 million at the end of year 4. So if I do not need to pay that, instead I'm returning the asset, my liability will be eliminated by 60, my right to use will be eliminated by 60. So this is why we deducted 60 in the depreciation, so that it remains there at the end of year 4, and so that we can match our liability with the asset at that point of time. Getting this thing, everyone, that we never wanted to depreciate 60 so that it can be eliminated by the lease liability at the end of the 4th year. And what if the lessor asks us to pay the GRV? In that case, our entry is going to be liability debit by 60 million and bank credit by 60 million, because we need to pay that amount. Yes, Merrick, we have got it right. But there's one more thing which we need to do in this case, that we are going to debit the asset by 60 million and we are going to credit the right to use by 60 million, because now we don't have the right to use, rather the asset now belongs to us. So if we pay the GRV, the asset is going to belong to us now. So there will be two entries: lease liability debit, bank credit, asset debit, and right to use credit. Yes, Merrick. Abdul Qadir is saying, sir, can you please repeat why have we deducted 60? Abdul Qadir, if we didn't deduct 60, what will happen? The asset's value will come at 0. And when we are returning the asset, what will be the credit amount? Because we have no right to use asset in the balance sheet now. So this will be a problem, that there is no asset and the liability is still 60. So what if we are giving the asset back instead of the liability? We won't have anything to credit. So that is why we deduct 60 from over here, so that the asset is there at 60 million at the end of the lease. Getting the point, Abdul Qadir? Okay, good. Yes, Jagmeet, in that case, it will be 0. So now, this is how we have accounted for the lessee's accounting in the financial statements. But but in this case, we actually took an example to understand the treatment. But in the exam, maybe you are not supposed to perform the calculation, but the examiner may ask you the accounting in theoretical terms. So what accounting are we going to do in the books of lessee? Now I'm going to tell you the rules that we are going to write in the accounting. In year 0, we are going to make an entry as the right to use debit and the lease liability credit. By which amount? By the present value of all future cash flows plus if any amount is paid as an upfront payment, as a deposit, as a down payment, as an immediate payment. This means that we would have paid the amount from the bank immediately. So for that, our entry is going to be right to use debit and bank credit. This is the amount that we have paid immediately. We can call this a down payment, we can call this a deposit, we can call this an upfront payment. So any amount which is paid immediately is going to be debited in the right to use asset. It's sort of a prepayment, yes, Jagmeet. Plus, if let's suppose if we have incurred an initial direct cost to bring the asset into usable condition, like we have paid any transportation cost, any installation cost, any site preparation cost, any consultancy cost, that will also be added in this entry, because that would also be paid immediately from the bank and that should also be capitalized in the right to use asset. So any initial direct cost is also capitalized in the right to use asset and paid on an immediate basis. Plus, if this right to use asset needs to be dismantled at the end of its life, in that case, we need to create a provision for dismantling as well. So we are going to record an entry as the right to use debit and the provision for dismantling credit. By which amount? By the present value of the dismantling cost. So we may also incur a dismantling cost at the end of the lease. Plus, there is one more thing which is important, that sometimes we receive an incentive with the lease. Sometimes we receive an incentive with the lease. Like let's say that if you take a car from me on lease, I'm going to gift you a tire. If you take an air conditioning on lease from me, I will gift you a fan as an incentive. So what if we are receiving an incentive for free of cost? So we say that there's nothing such as free, everything has a cost. So we are going to record the asset as an incentive and we are going to credit the right to use, because we are going to assume that the amount of the incentive is somewhere included in the amounts that the lessor is collecting from me. Getting this point, everyone? That if we are getting an incentive, we say that it is not free, rather the amount would have been somewhere collected from me, either in the lease liability or either in the amount that I've already paid. Sadar will not take the present value of the amounts that we are immediately paying or the direct cost, because that is a cost already incurred in year zero. So there's no need of taking the present value for that. Now, by what amount will this entry be made? This will be made by a proportionate amount. And what do we mean by the proportionate amount? Like let's suppose that we had a leased asset of, let's say, $8,000 and we are getting an incentive of, let's say, $2,000. So the total becomes $10,000, but because we are not paying any incentive, this means that we are getting this for how much? For $8,000. So if the lessee says that, look, if you take the asset from lease, it is of 8,000 and I'm giving you an incentive of 2,000 for free, I'm not charging anything. So the normal value would be 8 plus 2, 10, but I'm getting this for 8 only. So again, similar to IFRS 15, we say that the leased asset is approximately 80% of the standalone value. Incentive is 20% of the standalone value. So 80% of 8,000 being 6,400 belongs to the lease, and 20% of 8,000 being 1,600 belongs to the incentive. So the entry of the incentive will be made by 1,600 according to my example. Yes, Nimra, DC means dismantling cost. So the incentive, the asset will be recorded at the proportionate value similar to what we have done in IFRS 15. Nabia wants to repeat the percentage. Nabia, the value of leased asset was 8,000 out of a total of 10. So 8,000 out of 10 is 80%. 2,000 of incentive out of 10,000 is 20%. So this is how we try to find out the value of the incentive. So in year 0, we have recorded the right to use asset along with the lease liability, amount of the initial payments, any direct cost, any incentive, any dismantling cost. Now in year 1 onwards, every year we have to do two things. We have to record the finance cost against the lease liability and the payment. In this, the finance cost will always be recorded at which rate? At the implicit rate. Implicit rate is the rate which the lessor is going to tell us. And if we do not know the implicit rate, we are going to use the incremental borrowing rate. If we are unaware of the implicit rate, we will be using the incremental borrowing rate in that case. Plus, apart from that, every year we are going to charge the depreciation as well. So the entry for the depreciation is going to be depreciation expense debit and the right to use credit. And by what amount are we going to charge the depreciation? By the value of the right to use minus the guaranteed residual value divided by the useful life of the asset. So the depreciation is going to be the value of the right to use minus the guaranteed residual value divided by the useful life. And when we say useful life, there are two possibilities. That in some cases, asset is transferred to lessee at the end of the lease, and in some cases, the asset is returned to the lessor at the end of the lease. If the asset is transferred to lessee at the end of the lease, the useful life means the life of the asset. If the asset is being transferred to lessee at the end, the useful life means the life of the asset. So if the life of the asset was 10 years and the lease term was 4 years, so this means that I'm going to use the asset for 4 years, and after the lease, still the asset will belong to me and I'm going to use it for the remaining 6 years as well. So I'm going to benefit from the asset for entire 10 years. But in case where the asset is transferred back to the lessor, we use the lower of the life and the lease term. So if we need to transfer the asset back to the lessor in this example, we are going to charge the depreciation over the lease term in this case. Getting the point, Ripon? Your question was this was what I've just answered. That if the asset is transferred to the lessee at the end, we depreciate it over the life, and if the asset is returned back to the lessor, we depreciate at the lower of. Merrick, we will be covering IFRS 16 today, and I don't think that we are going to have time after that any. So this is how we are going to depreciate the asset after every year. Now, apart from this, there's one more thing which is known as lease exception, because the accounting that we have just discussed is quite difficult. And this difficult accounting should not be applied to all cases, So IFRS 16 has provided some exceptions in which we do not follow such complex accounting. Nabia is saying, sir, if we don't know whether it will be returned or not, Nabia, in that case, we are going to check what is reasonably certain, what is the estimate according to us, and we are going to follow the estimate in that case. Yogesh, there is no question in the past paper yet where we have the case of incentive, so we cannot solve any of the past papers question for that. So now basically we have two types of lease exception, that if we have a short-term lease of less than or equals to 12 months, we call that a lease exception. Or if we have a low value asset where the cost is less than and equals to $5,000, we say that it is a low value asset. And in these two cases, the standard allows us a simplified version of the accounting, so that so complex accounting is not followed in that. So the standard actually says that in case of lease exception, the lease payments are recorded as an expense over the lease term. So in these two cases, in case of short-term lease and in case of low value asset, we simply expense out the rentals on a straight line basis, which means that when we are calculating the expense, we say all of the lease rentals plus any initial direct cost minus any incentive will be divided over the lease term to get the expense for every month or every year. So if the lease term is, let's say, uh, 12 months and only 3 months have passed by, so we are going to record the expense of 3 months only. Yes, exactly, Amara. $5,000 that we have written is basically a guidance provided by IFRS 16. So this value is as a guidance, but it can vary according to the size of the company. $5,000 is a guidance. It can vary according to the size of the company. Alistair is saying, sir, either condition needs to be satisfied. Yes, exactly. It's an or in between this, either the first one or the second one. Yogesh is saying in your example on incentive, $1,600 should be deducted from right to use asset, and where should we take 6,200? Basically, in the example, Yogesh, we simply record this entry by 1,600 and it will automatically bring the asset to 6,400. So we actually process the accounting for 1,600 only. The remaining impact will automatically be incorporated on its own. Sridhar is asking that has the lease exception any effect on the SOFP? Basically, Sridhar, the lease exception will have an effect only if there's a difference between the expense and the amount paid. That will be taken to the balance sheet as a prepayment or as an accrued expense. Now, the third thing from the lessee's point of view is the sale and leaseback transactions. In case of the sale and leaseback transaction, we have to check whether the transfer of the asset qualifies for a sale or not. So we have two things: transfer is a sale, transfer is not a sale. And this is to be checked as per IFRS 15. If the transfer is not a sale, this means we do not treat it as a sale and leaseback. Rather, we call this a financial liability. So any amount received from the bank or the lessor is treated as a financial liability. The second thing is that if the transfer is a sale, in this case, we are going to record the entry as the bank debit, asset credit, and the balancing figure to P&L. This is the entry that we usually record for the sale of an asset. So first we have recorded the entry for the sale of an asset. So the bank will be debited by the sale proceeds. The asset is going to be credited by the carrying amount, and the P&L is going to be the balancing figure. So this is the entry that we usually record for the sale of the asset. And as we have not only sold the asset, rather we have also taken it back onto the lease, we should make another entry as the right to use asset debit and the lease liability credit. So we have simply combined the two entries of selling the asset and taking it on lease. So in case of sale and lease back, that's pretty simple. Record the entry of sale, record the entry of lease, and combine both of them. Now, by what amount are we going to record these values? The lease liability will be recorded as the present value of all future lease payments. It will be by the present value of all future lease payments. Now only the value of the right to use asset is left. Now the value of the right to use asset is going to be the carrying amount of the asset. By carrying amount we mean this carrying amount. Carrying amount of the asset multiplied by the percentage of the asset that we have retained. Carrying amount of the asset multiplied by the percentage of the asset that we have retained. And how do we calculate the percentage of the asset that we have retained? So the percentage retained is going to be the present value of lease payments divided by the fair value of the asset. This is how we calculate the percentage of the asset retained, which is then used to calculate the amount of the right to use asset. So these were the three elements which were necessary for the lessee accounting, the lease accounting, the lease exception, and the sale and lease back. Okay, Abhay is asking that why the retained percentage to be multiplied here. Basically, Abhay, the concept is that if I haven't sold 100% of the asset, why should I de-recognize 100%? So what we do is simply if we have retained 40% of the asset, we are going to re-record the 40% of the asset by the name of right to use. Nabia is asking that will the calculation not give a difference in right to use and lease liability amount? Will the balancing figure go to P&L? Basically, Nabia, there is going to be a single balancing figure for the entire entry. The bank, right to use, lease liability, asset, and then the balancing figure will go to the P&L. Sridhar is saying, so I didn't understand the ideology behind sale and leaseback. Basically, Sridhar, we don't have too much time to go into the ideology. Rather, we should be focusing more on this is to be done right now, because that will take further time and we still need to discuss the lesser accounting. We haven't discussed that yet. Okay, so if we move further, so now we are going to discuss the lesser accounting. In case of lesser, there are two types of leases. One is called the operating lease, and the second is called the finance lease. So there are two types of leases, operating lease and the finance lease. Adeola, by FE we mean the fair value. By FE mean the fair value. In case of operating lease, the rentals are recorded as an income on straight line basis. This is similar to the lease exception accounting. So in operating lease, we simply record the rentals on a straight line basis. Yes, Salman, we are going to discuss this tomorrow. So this is a simple formula. Rentals are recorded as an income on the straight line basis. The complex accounting is there for the finance lease. Now in finance lease, we need to discuss the accounting of two types of lessors. One is the manufacturer and the other is the non-manufacturer. So let's start from the non-manufacturing side. So let's suppose if we are a non-manufacturer lessor, what entries are we going to record in case of lease? So the answer for that is pretty simple. Lessor has just to follow the opposite accounting of the lessee. For lessor in year 0, as it is transferring the asset to the lessee, it should be de-recognizing the asset by crediting the asset. And in return, we are going to record the finance lease receivable as the debit. Asset credit and the finance lease receivable will be debited. By what amount? This will be recorded by the present value of all future cash flows. And from lesser point of view, all future cash flow means the rentals plus the GRV plus the UGRV. So we are going to calculate the present value of the rentals and GRV and UGRV, by which we are going to record the finance lease receivable. And in this, rentals, GRV and UGRV, the sum of this is given a name as the gross investment in lease. So we actually record the present value of the gross investment in lease as the finance lease receivable. Sabha, UGRV means unguaranteed residual value, which we discussed in this slide, this one, the the uh, the discussion which we had a while ago. So the rentals, GRV and UGRV are known as the gross investment in lease, and the present value of this is known as the net investment in lease. So we can say that the finance lease receivable is recorded at the net investment in lease, which is the present value of gross investment in lease, which means the rentals, GRV and UGRV. Jagmeet is saying that why do we credit asset? Jagmeet, because from the lessor point of view, the lessor has no benefit from the asset. The lessor is only going to benefit from the amount it is going to receive from the lessee. So that is why we are crediting the asset, removing the asset from the books of lessor. Mohammed Suleiman is saying, why take UGRV in this case? Mohammed Suleiman, because from lessor's point of view, it is going to receive both the GRV and the UGRV. So that is why we add both the values for that. Now, what accounting will be done in year 1 onwards? In year 1 and onwards, the lessor will receive the rentals in its bank, and it will reduce the finance lease receivable, and it will record the amount of the interest income. This is similar to the entry that the lessee was recording. The lessee was recording the finance cost, the lessor is recording the interest income. The lessee was crediting the bank because it has paid the rentals. The lessor is debiting the bank because it has received the rentals. The lessee has repaid part of the principal. The lessor has received the part of the principal. That is why the lessor will reduce the finance lease receivable. And in this, the lessor will record the interest income at which rate? At the implicit rate. So this is how the manufacturing lessor is going to recognize in its own financial statements. Okay, Milos is saying non-manufacturer means basically non-manufacturer means the bank or the leasing companies. So let's say I want a car on lease, so I have two options: either go to the car manufacturing company to take the asset on lease, or go to the bank to get it financed. So if the bank is accounting as a lessor, this means that the bank is a non-manufacturer. Sabah is saying, sir, what gross and what net? Basically, Sabah, the gross investment in lease means the total cash that we are going to receive. And the net investment in lease means the present value of the cash that we are going to receive. The gross investment in lease means the total cash that we will be receiving, and the net amount means that the present value that we are going to receive. Ashita wants me to repeat. Ashita, it will be very much time consuming if I repeat everything, and we only have 2 minutes. So the last thing that we need to discuss, we are going to discuss this tomorrow, about what if the manufacturer gives the asset onto the lease. The accounting is pretty much similar, that in year 0, the manufacturer will also record the finance lease receivable, but from manufacturer point of view, the asset is being sold, which it should be recording as a sale, because for manufacturer it's not an asset, it's an inventory. And whenever the inventory is sold, we also record the cost of sales as debit and the inventory credit. So from manufacturer point of view, we are going to record the finance lease receivable as debit, sales as credit, along with the entry of cost of sales debit and the inventory credit. And the amount of the finance lease receivable is going to be the net investment in lease. and the amount of inventory credit is going to be the lower of cost or NRV. So this is how the manufacturer is going to record in its own financial statements. So the accounting of year zero for the manufacturer and non-manufacturer is different, but the accounting for year one will be the same, that when the lessor receives the rentals, it is going to debit the bank, it is going to decrease its amount of receivable, and it is going to record its own interest income. So the accounting of manufacturer and non-manufacturer is different for year zero, and for the remaining years, it is the same for both of them. So that was all for today's session. We have completed almost all of the IFRS 16, IFRS 15, and we have solved one of the cash flow questions. And I think covering all these in only 3 hours was quite difficult, but Alhamdulillah, we have achieved it successfully. So thank you everyone. You are going to receive a feedback form after the completion of the webinar, and your feedback will be very helpful for me as well as the ACCA to improve the areas where we still lack. So thank you everyone, and looking forward to meet you all tomorrow at the same time. Till then, take care and Allah Hafiz.